everybody.
Sean and Kelly here, Price and Price Group, eXp Realty, and what are we talking about today?
What to expect financially when buying your house.
Okay, so you're getting ready to buy a house, you're
Right.
putting together all your finances,
Yep.
and you're thinking, I gotta save 20% for the down payment, or 10%, or 5%, or whatever it is, and you're thinking, that's all it's gonna cost me. Well, that's not the truth. We're gonna dive into
Maybe more, maybe less.
Maybe more, maybe less. That's right. You know, VA could be a lot less. You never know.
Also, conventional mortgages that offer only 3% down.
That's true. Okay.
FHA also is 3% down.
That's right. All these good
So many
things.
options for you to talk to with your lender.
Okay, so we're going to dive into, besides the down payment, what you need to expect financially in the transaction,
Yes.
what's going to be involved in escrow, so on and so forth.
Yes.
Okay, so the first thing we need to dive into is the purchase price.
Right.
Okay,
I mean, that's a big deal. That has a huge impact on what your cash to close and down payment and everything's going to be.
Yes,
That's
it does.
ginormous. It's
Yep.
kind of what the whole thing circles around, right?
so when you go to settlement, you're going to bring the purchase price to settlement, and how you do that will be a loan or cash or however you end up doing it. So, all right, so cash to close. Cash to close is the dollar amount that's due at settlement when you go
Right.
to the settlement table to sign. So what are you going to need to bring with you to the settlement payment or
Table.
settlement table?
Table?
Table.
The payment?
The payable payment.
Okay, you're going to bring your down payment,
Yes.
and this is whatever your loan program is, right? 3 to 20% VA. It's going to be 0%, but you're going to have more. So
Yep.
let's do it.
And keep in mind that a lot of buyers do ask this question: when do I have to have that down payment? And
Yeah.
it's at settlement. That's when you
Yes.
bring that there. Okay, closing costs. So this is what a lot of buyers don't think about.
Right.
And these closing costs that we're discussing here are for the state of Virginia. If you're buying in Maryland or DC, they can be significantly higher because the taxes are higher in those
Yeah.
areas.
And it makes sense that it adds a lot of confusion, right? Because it's not a finite number. It
Yeah.
changes by state, county.
Mhm.
It's like this to that percent. So it's
Yeah.
usually the numbers like that, a lot of people just tend to like let float off into the back crevices of their minds.
That's right. So closing costs, an estimate that we give to our buyers in Virginia, we like them to be prepared with 3% for closing costs.
Yeah.
That's usually overkill. It's usually closer to 2, but it's better to be more prepared than less prepared, depending on what's going to be required.
That's right.
So closing costs consist of
So many things.
so many things. Things like paying for your HOA docs that were previously ordered.
Right.
Prorations for your condo fees or your HOA fees.
Yes, sometimes any inspections that were done for the property
Yes.
that were sent to be paid at settlement.
Yeah.
Usually this is more like pest control. Typically home inspections would be paid for at the time of.
Yeah.
What else?
Lender fees.
Yes.
Proration of property taxes.
Title fees.
Title fees. Title
Recording of
insurance.
deeds.
Recording of deeds. Transfer taxes. WMATA taxes.
What?
Yes.
WMATA.
So these are all the fees that are required for the transaction to occur and all the prorations that come in.
And that is independent of what title company you use. We're talking about like the
Transfer
transfer
taxes,
taxes and all this, and
Yeah.
recording fees and WMATA and all that. That's independent of your lender, realtor, title company. This is all based on the property and the jurisdiction in which it lives.
Yep, and closing date, because that can get
Settlement date.
yeah.
True.
Okay, so and these closing costs, this 2 to 3% of closing costs are on top of your down payment. So you need to make sure that those funds are allotted, and these closing costs are due on the day of settlement.
Yes.
Okay.
Yes.
All right. Next, some agencies, some brokerages have brokerage fees, administration fees, and that comes out of pocket for the buyer. For example,
Yeah.
our brokerage charges $425. We've seen them as high as $795.
Yeah,
So
ours
we
is
just-
actually going up to $495.
Is it really?
Yeah,
Okay.
this year, and ours is still one of the lowest.
It is,
yeah, it's usually in the 5s. So,
yep.
whoop whoop, EXP.
That's
yeah,
right.
yeah, yeah,
That's
yeah.
right, baby. Okay, so you need to be prepared for that. And then outside of settlement, so those are all the things that are going to be due at the settlement table. So outside of settlement, in other words, before we get to settlement, which is usually about day 30 of the transaction, the first thing you're going to have to do is the earnest money deposit.
Yeah, and that's going to be sent based on what we put in your offer, which turned into your contract, right? Usually 3 to 5 days So those are funds that you need to make sure you have accessible right then as soon as you're submitting the offer, because once it's accepted, you only have that many days to get it in. And usually it's wired. Which is a great time to mention that your realtors, nor your title company or lender, they're not really going to ask you to wire funds through email or anything like that. It's going to be a phone call. You reach out, get in touch, ask for their wiring instructions. So be careful. Wire fraud is
huge.
A big bad.
Yes. Big baddie.
Big baddie, bad guy.
So in the current market at the time of shooting this video, earnest money is usually 3 to 5%. The more competitive the property is, the higher you need to make your earnest money, because that's the money that is your good faith deposit to the sellers to give them the confidence that you are serious about buying the house, because that's what you are basically risking from your contingencies.
Yeah, and this is even if say you're a VA buyer and you're not going to have any money down, you still want as big an earnest money deposit as you can afford, because it does speak to the seriousness of your offer, right? Why is that? It's because if you defaulted in any way on that contract, the seller gets to keep that money. So you have to know you're serious. It shows them you're serious, and then you're probably about to get to this. So I wonder if I'm skipping ahead. But whatever earnest money deposit you pay, that's going to be subtracted from the cash to close you're going to have to bring to the table. So let's say you needed to bring $50,000 cash to close, and you put $25,000 earnest money deposit. These are wackadoodle numbers. Then you would only be bringing $25,000 cash to close, which is the balance of those two.
And if you're a VA buyer and you don't have closing costs that equal that, then you'll get a check back.
That's true.
That'd be nice. Buy a house and get money back. It's kind of money back. Home inspection. So home inspection is due at the time of service. It can range depending on the size of your property, anywhere from $350 up to, we've seen them as high as $1,500 depending on the size of the property. On average, $350 to $750, and you're going to pay for that at the time of service. So you need to be prepared for that. And one of the things to keep in mind with that is if you're doing pre-offer inspections, so on, you might want to have a little bit more liquidity so that in case you miss out on a couple properties, you can afford a couple of inspections.
And you're like, why would I do that? Well, if you've been in this market as a home buyer, you know why you would do that. If you haven't yet, you're gonna learn. It's because it's a really competitive market out there, and sellers are not really wanting to accept offers with home inspection contingencies. So it's best if you really want to have one, which is a great idea, do it before you submit the offer, right? And then, that's what a lot of other buyers are doing. So you might still lose and then need to do it again on the next one.
That's right. And the whole purpose of that is so you know what you're buying and you decide, do I still want to write the offer or not? If you do want to write it, you write it without the or contingency, because you've already seen the inspection.
That's right.
Okay. Wood destroying insect inspection, anywhere from $40 to $70. This is usually right around $45, $50. But you need to be prepared for that. This can be paid at time of service, or a lot of companies accept it at settlement. So this could be either or. That's like the cost of a family of 4 at Taco Bell. Do you realize, we used to get like 10-cent Mix-A-Melts at Taco Bell? We used to go there for $10 with all 6 of us.
And now, just like $46.
And they got rid of the Mix-A-Melt.
And the Pico de Gallo. Like, what am I even paying for Taco Bell?
They get rid of the Burrito Supreme, we're out.
I'm already about out. They're making me mad.
All right, we're destroying insect inspection. Appraisal. So the appraisal, this is different than an inspection. A lot of people get inspector and appraiser confused. An appraisal is the independent party that goes into the property and determines the house value.
I smell good.
Determines the value of the house, so the lender is confident that they're lending on a property that is worth what they're lending the money on.
That's right.
Your lender will charge you for this appraisal.
And they're going to send you the link as soon as you're under contract, right? And the reason, and you need to pay it immediately, because an appraiser is not going to accept I smell good too. Sorry, I'm such a weirdo. Get it out of my system. Okay. An appraiser is not going to accept the job to come out and do your appraisal until payment has been received, right? To have a competitive offer, you want your appraisal and finance contingency window to be as small as possible, so that they need to get the appraisal done really, really quickly, which means the appraiser has to accept the job really, really quickly, which means you have to pay for the appraisal really, really quickly, which means your lender has to be the type that orders it really, really quick. That's right, boys and girls. Even Why are you changing my slide?
Sorry.
Even on nights and weekends, right?
Yes.
They can tappity tap the old thing in the computer, the old order, and they need to do that. If you have a lender who doesn't work nights and weekends,
Okay.
call Tatiana.
Can you say
Sorry,
tangent?
tangent.
Yes. Okay.
I need to have like a jingle for Kelly's tangent time.
Kelly tangent time.
Kelly
Our whole new
tangent
thumbnail.
time. If you see this, it means just fast forward through it. Because it's Kelly tangent time. Kelly tangent time.
In an email voice. Kelly tangent time. I can't even say it.
That
Okay.
sounded like Mr. Hanky.
That's right. Oh no, it's Kelly tangent time. Okay, anyway.
Oh, man.
So cash to close, due at settlement. That's when you're going to settlement. Before you get to the settlement process, just be prepared for your earnest money deposit, your inspection fees, wood destroying insect inspection, and your appraisal.
Yeah, and a note on all of this money: have your money ready
Yes.
for the outside settlement stuff there at the bottom. Have it immediately ready because it's going to be a really fast process from the time your offer's accepted to settlement date.
Yep.
And then for the final, the cash to close due at settlement, have that ready. If it's in
Money market funds or investments.
sometimes we've seen it happen again and again and again. It takes a lot longer to get those funds to an actual bank, wireable, transferable than people think. And if you're having to delay settlement or something, that could, if the seller doesn't agree, that's you not making good on your contract, and they can say, we're either going to settle or I get to walk with your funds, your EMD funds, and I got a better offer waiting in the wings anyway. So just have your cash ready. Talk to your lender about that. They'll make sure that you know.
That's right. Okay. So that is what it takes to buy a house. All right.
A lot of money,
A lot of money, baby.
baby.
All right. Okay, so we're going to get on with the market report and then get over to Tatiana for the mortgage minute.
But you know, hey guys, now I'm introducing the market snapshot for the week, and if it looks different, it's because it's now Fairfax County instead of what it was before. How did I do?
You did great. Okay,
Yay.
so Kelly's now joining us for the market snapshot, y'all.
Well, I don't know if this is like permanent or anything.
Yeah,
I'm
well-
just still here. I haven't left yet.
All right, so we're about to dive into the last 7 days of the
wait.
market.
I'm gonna look smart. with
For those of you
numbers.
who have been watching this every week for the last year, the graph is going to look a little bit different because I've expanded it out to go from just Vienna, Great
Just-
Falls,
yeah,
and
right, just
McLean.
begin, and now
I put it out to
it's
Fairfax County. Yeah. So this is the market report for the last 7 days for Fairfax County. Here we go. Let's get to the graphs.
Let's do it, Sean.
Okay, as always.
Buyer activity versus inventory. Tell us about that.
Okay, so buyer activity is. So I've challenged Kelly with this because we have to keep this under 5 minutes because that's the purpose
Oh, that's
of the
right.
snapshot.
5 minutes. Okay.
All right, so buyer activity is always the orange line, and inventory is always our blue line. And you can see that buyer activity did come down a little bit in the last 7 days. Inventory for Fairfax County increased over the last 7 days. So we're seeing a nice trend upward of inventory as we start going into the spring.
But
And we're-
will they converge?
And then we're seeing a more significant uptick in buyer
It doesn't
activity.
look like it.
So the gap here between buyer activity and inventory is what brings us
That's
over
where we're
here
missing out, people.
into the seller's market. So we are in the seller's market.
Always.
You can see that we have been steadily increasing upwards.
That's right.
And this is what we're seeing. We're seeing multiple offers on almost every property that's
Every
coming to the
single
market.
property.
So buyers, you just got to be prepared. Make sure that you're strategic with your offer.
Very strategic.
And you need to get into the market now.
Right now.
Because look what happened.
Why
at this,
didn't you get into it with the little dips down there?
Yeah,
That's what I want to know. Those of
these
you,
right
maybe
here.
you were sick.
Right there. That's where they should have gotten into
That's
it.
when you should have
That's
done it.
What we've been talking
like
about.
let's look back and see what were you doing then that you
They were
wish
waiting
you had
They were
done
waiting for interest
something
rates.
different.
They were waiting for interest rates to come down.
It's
just like
not going to
everybody else.
happen,
Yeah,
everybody.
yeah, rates are coming down. But now they are coming down. That's
I mean,
why.
it already did, so it's not going to happen again until like after March.
and here's the challenge. So this is this is last year, and this is what happened even with the high interest rates. We saw the spike go up. So
Now, I will say on the news, hang on, how much time do we have? Oh, really quick. I will say on the news this morning, they were saying that houses in our area over $1 million, the prices increased by like 9%. Everybody, 9%. Okay.
yeah, it's crazy. So prices are still going up. If you're a buyer, I know it's kind of crazy right now, but get into the market now because before this spike happens, Once this happens, we're getting back into 15, 20, 30 offers a week.
Like crazy.
Sellers, get your house on the market now. It is time. Inventory is going up, but the buyer activity is going up. You will have more competition if you wait till the spring. So
why don't you not wait until the spring?
Why not? I mean, why don't you not? Okay. All right. So that's the market snapshot for the last 7 days. Basically, the market is picking up and it's becoming the wild, wild west again.
You got to stop and everybody vote on if I should be a part of the market report next time. We have like one watcher, right? I wonder if they're going to say,
there were 3 last week.
Yes. Yes. I'm going to have a majority possibility. What?
It's possible.
Probably.
Kelly, tangent.
Okay, this is my first and last time on the market report.
I like you being here. Okay, off to Tatiana.
All right, and now we have Tatiana with us for our Mortgage Minute. Hey, Tatiana.
Hi guys, how you doing?
How you doing?
Good, thank you.
So what's going on with the interest rates this week?
The interest rates didn't really change. Well, let me take it back. They got a little better from the last week. The last week they were
up a little bit, hadn't we?
Can you see it?
Oh, we're losing you.
Can you hear me?
Yep, got you now.
Got you now. Right there.
Okay. Can you see the chart?
Yep.
Yep, we got it.
Perfect. I don't know what happened. I'm on I'm hardwired, but
yeah, that was kind of weird.
All right. So the rates actually went down slightly from the previous week. So they're at 6.63 versus 6.69. In the beginning of the week, we had a nice drop. Now the rate goes up a little bit. So if we compare to the same time last year, in January or February now of 2023, the rate was 6.09. So it's slightly up from the last year. However, you know, it's down comparing to a couple of months ago, right? So while rates remain a little bit elevated, the Fed recently signaled that it will begin to cut rates in 2024, indicating a further downward shift in the mortgage rates that may come soon. So that's a good news. Rates are good. Like in general, if you look at this line right here, we did have these rates in 2006, 2007. Once the rates gonna start go down, we can refinance again. You know, I always say buy right now if you can, if you qualify for it, if you can afford it, and we can refinance later because they drop a little bit. We're gonna have more competition going on.
That's right. Yep, and it's happening. We're seeing the multiple offers all over the place right now.
Yep, so. And you're buying at these prices, which are much better than they're going to be even in a few months.
Yep, absolutely. Exactly. It's interesting that this graph, you know, you look at, what was it, 2002, 2003, we were below that 7% mark, you know, for the last, 21 years. But prior to that, for, I don't know the math, 30-something years, it didn't get below that 6.5%, 7%. It was just normal for it to be as high as it was.
Exactly.
So we got kind of spoiled the last couple decades.
Yeah, that's right.
We got spoiled real fast.
Yep, we did. All right, so we can expect the rates to come down here soon, and again, Tatiana brought up a good point. A lot of buyers are going to hear that and they're going to be like, okay, great, we're going to wait for the rates to come down, and that's a mistake because as soon all the other people that are waiting, it's going to flood the market and those prices are going to skyrocket. So
we're already seeing such an uptick in buyer activity right now.
Yep. Okay. All right. So we have an exciting subject today to talk about, and I'm going to let you introduce it because this is something that's beyond I kind of foreign language.
10-year yields, but like what even is it for?
And what is it do?
Exactly, good question, and that's what indicates where the interest rate's gonna go up or down, the 10-year yield. So let's see what it even means. right?
Yeah,
So the
frozen.
10-year treasury yield
Okay,
is
stand by for just a second. You froze again.
what about now?
Hey, Tatiana, you're
you-
freezing.
Can you
Yeah,
hear
you're
me?
good now. Okay, so we had difficult.
We're
This is
having
our-
all kinds of difficulties today.
Yes, this is our fourth attempt just to shoot this video. So we had technical difficulties in our Zoom with Tatiana. So she is recording that. She's going to send it over to us. So as soon as we end this video, we're going to get that on here and get
And I'm
you.
probably never going to see it, and so I'm never going to know about a 10-year yield.
You're going to have to watch it. You'll be number 2. Yes.
I'm going to like us.
That's
I'm
right.
gonna
Oh, you
thumbs up
should.
us.
Yes, and subscribe.
What? How do you even do that?
I don't know.
Is there a button?
Yeah. Okay, so.
I'm on my social media fast.
Oh man, you're never.
For it, I'm about to end my 3rd week, and it's been glorious.
Yep, you're never going to see it.
Probably not.
Yeah. Okay. All right, here we go. Here's the presentation.
So I'm sure people hear about 10-year treasury yield and that it correlates with the interest rate and its indicator of whether the rate gonna go up or down. So what does the 10-year treasury yield even means? Let's just talk about that. So the 10-year treasury yield is what US government pays investors to purchase the specific security with a maturity of 10 years upon initial assurance and issuance, and is generally considered risk-free. Essentially, the 10-year treasury yield is the current rate investors would pay if they bought them today, and can be viewed as indicator of economic growth. Historically, the 10-year treasury yield has been considered a key benchmark for the mortgage rates. However, mortgage rates are not actually based on US Treasury note or Treasury yield as commonly believed. So the yield is considered a marker for investor confidence in the markets, shining a light on whether investors feel that can make a higher return than the yield offers on a 10-year note by investing, let's say, in stocks or some other riskier securities. So basically the 10-year treasury rate or yield refers to return expected on 10-year treasury note sold today. So the mortgage rates, they're tied, so to say, to bonds, and bonds are safer than stocks, right? So when the prices for 10-year bond drops, and they drop when the confidence is high and investors feel that they can make higher return in investments elsewhere, like on stocks or ETFs. So they buy stocks, and because of that, the 10-year bond drops and 10-year treasury yield rises. And in contrary, when the confidence is low and investors start buying bonds, the bond prices go up and yields fall as there's more demand for these safe investments. So when bonds prices rise and yields fall, the mortgage rate follow and they fall as well. So here, the fixed mortgage rates and treasury yield generally move together, right? So why? As a fixed rate asset, mortgage-backed securities are direct competition with treasury investments for investors' money. So for mortgages to stay competitive in the eyes of investors, the rates on the mortgages inherently follow changes in the yield, the treasury yield. So right here we can see this is the 30-year rate and the dark blue and light blue is treasury yield. So you can see that they actually move parallel to each other. And another fun chart here shows in red we have prime rates, and in green we have 30-year mortgages, and in yellow we have the 10-year treasury yield. So you can see yellow and green, it moves all together. The prime, there it's a little bit up and down, but in generally, you can see that they all move, they have about the same trajectory. They all move together. If you have more questions, I'll be happy to explain more. You can Google or give me a call, 571-245-3000.